now, so there might be questions where you have to solve like this. Let me tell you. If a question says there are tax losses, I'll write it down as well. Okay. If a question says the tax losses can be carried forward, high chances that there will be certain tax loss. In those questions, you will not do a working of tax allowable depreciation. Okay, so I'll write it down. Within taxation only as a note. So notice, if a question says tax losses can be carried forward, high chances there will be losses in some of the year. In these questions, don't solve TAD as a working, but don't solve TAD as a working in these kinds of question, everyone. But what you are supposed to do, but deduct depreciation first and then calculate tax. And then add depreciation back. So in these kinds of questions, we are supposed to do this thing. If a question says that there will be certain tax losses which can be carried forward, high chances in those questions you will see that there is a tax loss. So what you are supposed to do in this question, you are supposed to not prepare a TAD working, but you are supposed to deduct depreciation first, then calculate tax, and then add back the depreciation so that there is no depreciation which is included in the cash flow statement. So definitely we'll do 1 or 2 questions which is based on this topic as well. Today we will start a new topic of adjusted present value, everyone. I hope that we all are very much aware of this topic. We had a conversation regarding this, that we'll start this topic in the next class. And I guess today is the time that we should start the adjusted present value. So first of all, before I move forward, there is something that I would suggest all of you to please write down. Now, first of all, let's talk about why do we started using the APV. What was the problem with the NPV part, everyone? Okay, so now there are certain problems because of which we started using the NPV, everyone. Now, what are those problems? What are those problems? See, we have been studying up till now that NPV is the best technique out there. Correct. That's what we have been studying. Coming back to adjusted present value. Now, what are the problems with the net present value, everyone? So first of all, sometimes we invest in a project only because we are getting a subsidy. So when I talk about NPV, NPV does not consider this subsidy benefit that we are getting. So one problem is NPV does not consider or does not, take into the factor the subsidy benefit that we are getting. That is one problem. So I'll write it down as problems with NPV. First was no consideration of subsidy benefit. This is the major problem. Second problem with the APV, not sorry, NPV only. Second problem is the interest that we are paying. So guys, whenever we have to take on a loan, we have to pay interest on that loan. Correct? We have to pay interest on that loan. Right? Now, because we are paying interest, we are also getting tax benefit. But we do not consider that. This is another problem that NPV is actually solving for me. So, no consideration of tax benefit on interest paid. Third, no consideration of issue cost. Now, to take on a project, guys, to take on a project, you will have to raise debt, you will have to raise equity. But don't you think there will be certain cost which will be associated just to raise that amount? Don't you think that, everyone? There will be certain cost which is associated to all of these. This cost is called as issue cost, everyone. This cost is called as issue cost. Okay. So now all of these problems that we are facing right now, they are solved using adjusted present value. All of these costs are solved using adjusted present value. Now, how we are going to solve this question? For that part, just do one thing, everyone, note it down. See, the APV questions are solved using two methods, well, two steps. First step mein beta you go and solve base case NPV. Now, what is base case NPV, everyone? It is the value of an all equity financed project. Value of all equity finance project. So now you might have to find out the value of the cost of equity in case there was no debt. Value of equity in case there was no debt. If you remember, guys, if you remember while solving CAPM, you used to take beta equity. Beta equity consists the risk on equity because of loan. So why don't we take beta asset only rather than beta equity? So in these questions, sometimes you have to solve using beta equity only. Sorry, beta asset only, the very first step. In the very first step, you have to just solve for the beta asset, nothing else. Okay, that will be your base case NPV. Second, you have to consider the present value. Remember, you have to consider present value of all financing effects. Now, what are they? First, tax benefit on interest payment. Second, subsidized loan benefit post tax. And all of these will be present value. Third, post tax cost of raising finance. Post tax cost of raising finance only in debt. Within debt, we have to consider post tax. Within equity, we have to consider pre-equity. Okay. Generally, it will be given. If issue costs are tax allowable or not. If it is not directly given that these are non-tax allowable, then we don't have to worry. Okay, so just note it down, everyone, and then we will move forward with a one large question on APV. Okay, coming to the top. Amberle is a listed company with divisions which manufacture cars, motorbikes, and cycles. Over the last few years, Amberle company has used a mixture of equity and debt finance for its investment. However, it is about to make a new investment of 150 million in facilities to produce electric car. Okay, Amberle's finance data has prepared estimates of the post-tax cash flows, which is given over here. Directly, we have post-tax operating cash flow. So we can directly take that. We'll put down year 0, 1, 2, 3, 4. Correct. Post-tax operating cash flows are given. Post-tax operating cash flow will be 28.5. Then we have 36.7. And then we have 44.4. What is wrong? Why? And then we have what 50. So these are my post-tax operating cash flows, which are directly given. Make things easy for me only. Working capital 6 million not included in the estimated above, and are funded from the retained earnings will also be required immediately for the project, rising the predicted rate of inflation, rising by the predicted rate of inflation each year as well. So definitely we have to consider second thing would be working capital. Now working capital may it will increase by the rate of inflation. So we'll have to do a working over here. Bracket में W1. Okay. So workings we can create over here. Workings. Working one will be your working capital. Now, what do we have in working capital? 8%, 6%, 5. 6 million is required at the start. So 0, 1, 2, 3, 4. So I'll put down total requirement. Year 0 it will be 6 million, everyone, because that is the total requirement. Correct? So we can say either in year 0, or we can say either in year 1. In short, if I have to write down, I'll put down in year 1, I'll require 6. Then year 2, I'll require 6 multiplied by 1.08. Then I'll require whatever the amount multiplied by one thing 1.06. Then I'll require whatever the amount multiplied by 0.05. Correct. This is the total working capital which I'll be requiring. Now notice one thing. I'll just make it to 0 over here. Otherwise, you guys might get confused. That is fine. Chalo. Because year 1 में that will remain same. It is not going to change. Okay. Because after year 0, it will increase. So what is the net requirement. Year 0 पे will require 6 minus 0, same amount. Year 1 पे I required this minus this, and then it will continue, and at the end I will get this money back. So this is the net requirement that I have for my working capital. Working capital I'll take from here and I'll just slash it down. I just have to drag it and I get all my working capitals over here. Then I'll put down investment. See, now I'm not considering tax or anything. Why? Because the cash flows are directly given as post-tax. Otherwise, I would have to solve as the basic question of NPV if nothing was given over here. Okay. Investment is how much? 150 million minus 150. And then scrap is how much, everyone? 45. Okay. So these are the final values that we have. So can we find out net cash flow? This value plus this value. This value plus this value plus. So now we have the final cash flows. Now we have to consider if the discount rate is given, and remember the discount rate should not have the debt component. So we'll come to the last point. Amberle's asset beta is currently estimated. Asset beta is given, then it's good. We can directly find out CAPM. 1.14. The current rate on the market is 11 and the risk-free rate is given as 4. So a suitable all equity finance. Important point. We have to consider all equity finance and that is directly given as 12%. So guys, we are not going to calculate that thing over here. Otherwise, we would have to calculate it as well. We will not calculate it over here in this question, but otherwise we would have to calculate. So now I'll just put down present values. Bracket में I'll pull down 12% equal NPV bracket open 12% comma, take the values from year 1, close the bracket. You will write down net present value as this amount plus this amount. So now your net present value is coming out to be negative. But remember, this is only base case NPV. Guys, this is only base case NPV. We are still supposed to solve for tax benefit on interest payment, subsidized loan benefit, and post-tax cost of raising finance. We are still supposed to solve 3 things. So let's start by one everyone. So can we go and start with subsidized loan benefit? Do we have a subsidy? The finance director has proposed the following finance package for the new investment. Bank loan which is repayable in equal annual installments over the project's life, interest payable at 8% of 70 million, and subsidized loan from government loan scheme over the project's life on which interest is payable at 3.1 of 80 million. So we have to consider a loan of 80 million, everyone. Okay. So now I'll come over here. Tax. So there will be 2 things, everyone. We will have to consider subsidized loan benefit first of all. Okay. Just a second. Now, subsidized loan benefit. Over here, I'll just first point we are solving subsidized loan benefit after tax. Now, what is the total subsidy that we are taking? 80 million multiplied by what is the net benefit that we are getting? Guys, if you look, generally we are paying 8% interest. Because of subsidy, we are paying 3.1% interest. Simple. So what is the net benefit? 8% minus 3.1%. Whatever value we will get, we will have to pay tax on that. Tax is how much? 30%. So how much are we left with? Sir, 70%. Correct, everyone? This is what we are left with. Now consider one thing very important. But this loan benefit will remain same for year 1, year 2, year 3 and year 4. Don't you think so? It will remain same from year 1 to year 4. So can we go and find out the annuity rate for 4 years? Now you have a question on, sir, what interest rate? Always take the interest rate of loan, the normal loan, which is 8%. Interest rate of normal loan. So annuity for 4 years at the rate of 8%. Annuity for 4 years at the rate of 8%. How much is that, everyone? 3.312 multiplied by 3.312. Simple. Click enter. Now you have the subsidized loan benefit. I'll bold it as well because at the end I have to, add up all the values over here. So better if we bold it. After that, we have to calculate interest benefit on. First of all, let's calculate issue cost. Issue cost is given or not. Issue cost of 3% of gross proceeds will be payable on the subsidized loan. No issue cost will be payable on the bank loan. Issue costs are not allowable for tax. So we don't have to consider any tax benefit, everyone over here. And there will be just one issue cost, which will be your subsidized loan. So how much will be that? 80 million divided by gross. It will be gross value, everyone. Remember. So divide by 0.97 and then multiplied by 3%. Okay. So now you will have the gross value. Because it is given as gross value, that is why we are dividing it by 0.97. That is why we consider 0.97. If it was net, then we don't have to worry and we could have taken 100%. Press enter over here. Now, issue cost beta, if you notice, we are not putting down any present value concept. Why? Because issue cost is just paid 1 year and that too at the start of year. There is nothing like a next coming year. So that is another value that we have. After that, we can move to tax shield. Are we left with anything? Directly tax benefit. Tax shield on two things. Tax shield on normal loan and subsidized loan. So let's take subsidized loan. So now subsidized loan, beta, how much loan do we have? Sir, 80 million multiplied by what is the interest rate that we are supposed to pay? 3.1%. That is the net amount of interest that we are paying. On that interest, I'll pay only how much tax? 30% multiplied by 30%. then whatever the tax benefit I am getting, I'll get it for 4 years, year 1 to 4. Interest rate again at the rate of 8%, put down annuity 3.312. Is this clear, everyone? Why are we putting annuity 3.312 again? Listen carefully. What happened over here? Now we need to find out tax shield, the tax benefit that we are going to get. Are you getting my point? Now we have to consider the tax benefit that we are going to get. And how do we calculate that tax benefit? Whatever the net interest we are paying, find out the tax payment on that interest. Find out tax payment on that interest. Whatever net tax payment you have to make, whatever net tax payment you have to make, you will be paying that from year 1, year 2, year 3, year 4. Same amount of tax. So directly you can take annuity instead of normal discounting. You can directly take annuity over here. Press enter. That's it. Tax shield is completed. This is on subsidized loan. This is on subsidized loan. Now we have to calculate tax shield on normal loan. Now, if you notice, there is one issue with the normal loan. Normal loan pe we don't have the interest rate that we are supposed to pay. Guys, if you notice, we cannot find out the interest rate. You might say, sir, we can pay 8%, that is fine. But the point that there will be equal annual installments, that will change the game. So first of all, over here, what we have to do, we have to find out installment amounts. Correct? We have to find out the installment amounts. That will be equal to 70 million divided by equals 70 million divided by, again, divide by the annuity factor. Divide by the annuity factor. Annuity factor again 3.312. 8% 4 years. So this will be the amount of installment that we are going to pay every year. Now I come on the working. Opening balance. Opening balance. Interest charge. Interest paid. Amount paid. Value. Okay. So now what is the opening balance over here? 70. Interest charge will be how much? Simple, 8%. This value multiplied by 8%. Amount paid will be 2.1.
Welcome to VoiceOver.
Sorry. Dollar. I'm fixing this. Closing balance will be equal some bracket open. Take up all the values. Now opening will be this much. Are we getting zero, almost zero at the end? That is my important point. This is the important point. Now, this is the interest charge that we have. So I'll find out interest charge. Interest charged. Why? Because the interest will be charged different amount on a different year. So I take it a low. Here 1, 2, 3, and 4. 1 pe how much are we charging? 5.6. 2 we are charging 4.3. Then we are charging 3.01. Then we are charging 1.565. This is the interest that we are charging. Okay. Then after this interest charge, we have to pay what? Tax. We'll get tax benefit that will be equal to this amount multiplied by 30%. 1.68. Same amount we'll get every year. Now, can we go and find out the NPV directly? I don't need the present values. I can find out the NPV using the NPV formula equal NPV bracket open 8% comma. I'll take up all the values bracket close 3.74. Simple direct. So tax yield on normal amount will be equal to 3.74. Okay, simple directly we can take that. And if you want, you can cut it over here and make it a part of your working. Control X. Two. I'll put it working two. And then I can put down adjusted present value over here, which will be equal to net present value plus subsidized loan benefit minus issue cost plus tax shield plus tax shield on normal. So what is my adjusted present value over here, everyone? 7.67. This will be my total value. Okay. So this is how you are supposed to solve a adjusted present value question, everyone. Just take a look. Okay, so one point that I would like to add on over here, certain times the examiner directly asks you to find out whether we are supposed to take on NPV or APV. What they ask you is find out the financial acceptability of the project. If this type of question is given, take a look at if there is any subsidy which is being provided, if the issue cost has been discussed, or if the all equity financing or any kind of these things are discussed. If any of these are discussed, it means you are going to take care using APV rather than NPV, everyone. Okay, guys, I have shared one question in the WhatsApp group to all of you. Please start solving this question. You guys will have 30 minutes to solve this question. Okay, let's solve this question. Rounding company is a company currently engaged in the manufacture of baby equipment. It wishes to diversify into the manufacture of a snowboard. The equity beta is given as 1.27 and its current debt to equity ratio is 25.75. However, the company's gearing ratio will change as a result of new project. Firms involved in the snowboard manufacture has been provided. The data has been provided. Chalo, ठीक है. We got why we are given this much of data, everyone. Uh, First of all, we have to solve for base case NPV. Purchase of new machinery costa, which will produce annual cash flows. 0, 1, 2. Annual cash flow is given as how much, everyone? 450. And do we have anything else? So we have corporation tax. And then do we have corporation tax? The tax level depreciation needs to be calculated, everyone. Now we will start workings in 101. Sorry, we don't need this. Opening depreciation. What is the opening value, everyone? 800. 800 is the starting value. 800. Depreciation will be this amount multiplied by 25%. Closing will be this amount minus this amount. What is the tax? This amount multiplied by 33%. Is the value at the end or something you enter it will have no scrap value. So year 3 may the value is going to be scrapped. Depreciation 450. Okay, so the tax level depreciation will be this amount. Okay. Okay, 100. And then counting factor. Now, base case NPV may, if you remember everyone, we have to consider what value? The all equity financed discounting factor. So all equity factor. So now, if you notice, everyone, the new project we are planning to. We are right now into the manufacture of baby equipment, and we are planning to enter into the snowboards manufacturing. Everyone, right? So we have the equity bit of a snowboard. We have equity beta of a snowboard. Can we find out the asset beta for the same? How do we do that? We have already learned this technique of doing this thing. 1.19 multiplied by 30 is to 70 is the ratio. Value of equity is 70 divided by another bracket open 70 plus another bracket open 30 into 1 minus t. T is 33. So it will be almost 67%, I would say. 0.92. This is my beta asset. Now, this is my beta asset 0.92. Can I go and now beta use this beta asset to find out your cost of equity. So my cost of equity will be equal to risk-free rate 10 plus beta asset 0.92 multiplied by 16 minus 10, which will be equal to 6. Cost of equity is 15.5%. We can take up, let's say, 16% for the sake. So I'll put down cash flows. Discounting factor. And discount present value at 16%, comma, take the values. Net present value will be equal to this amount plus this amount. So now the net present value is 65.96. Right now, this is base case NPV. Still, we have to solve for other things, everyone. For example, we have to go and solve for second thing that I'll solve is the bonds are going to be 40%, 60%, issue cost are given, 4% gross equity issued and 2% on gross debt issued. Assume debt issue cost are tax deductible. Okay. So we can go with the issue cost. Total is 400. We'll go with debt and equity. So debt mein how much we have? 40% equal to 40% into 800. Then over here 60% into 480, 320. Okay. Then issue costs are directly given over here. 4% and 2%, everyone. So that will be debt make is how much, everyone? 2% on gross debt divided by 98 multiplied by 2. 6.53 and equity में this amount multiplied by 4 divided by 9 divided by 96. Post tax, if we have to consider, because it is tax allowable, right? Debt issue cost are tax deductible. So this amount multiplied by, we are getting the tax benefit of 33%. So what is left over? 67. 4.37. So over here I will take this, and equity mein beta I will take this value. This is important. What value we are supposed to take in equity and what value we are supposed to take in debt. Then we don't have any subsidy that I can see, so we will directly move on to the next part. Present value of tax shield from off. Present value of tax shield on interest. Now notice one thing, everyone. Over here, the final amount is not given. How much bond or how much equity we are raising. It is given in percentage, right? It is given in percentage. So now total value of debt we have to find out. Total value of debt, that will be equal to, so 320 plus 6.5. So this is the total value of loan that we are going to raise. Now annual tax relief, everyone. Again, that is again something important that we have to consider. It will be this amount multiplied by, do we have the finance cost given? 10% we can take, risk-free rate, easy for us. Divided by 10% multiplied by, now 10% will give me the total interest. What is the benefit of tax? 33%. Then multiplied by annuity factor of 3 years. Annuity factor 3 years, 10%. How much is that? 2.487. So annual tax relief will be 26.79 everyone. This is the annual tax relief. We don't have anything else. No, we don't have any subsidy benefit. We don't have any tax benefit on subsidy, interest benefit on subsidy tax. So we'll go with APV over here. This value minus this plus this. So APV will be 68.38 everyone direct. Guys, if you have any doubts, please let me know. Arivindan, Midhun, Rafit. This question was pretty simple as well. Now, what you have to do, everyone, I want all of you to please go and solve more questions which are based on this topic only. If you have any doubts, then definitely feel free to reach out to me. I would be more than happy to help you out in that case. Okay, so if I have to just give you a summary over what we did new in this question. So first of all, beta, while solving base case NPV, we find out the discounting factor using the beta asset. Always remember this type of question can be tested where you have to use beta asset to find out the cost of equity. Why not beta equity? Because in base case NPV, we do not consider the value, the consideration of debt is not given. One thing. Second, issue cost में बेटा we did one thing new over here. We took post tax on debt. Why? Because the question clearly said we have to consider post tax. Now, while finding out the tax shield, the total value of debt actually we increased the total value of debt. Right? Why do we do that, everyone? Because debt is given at a percentage basis over here and not an absolute value. Also, debt was given as gross. That is why it is fine. We can go and increase value. If you look at the last question, the direct value was given. The direct value was given. So that is why we were not taking anything over here. We had to consider a direct issue cost.